Cool. Thanks for the kind intro. I told Domas that he could make up one thing about me in the introduction, so I'll leave it to you which of those things was. Just to quickly intro a little bit more myself, we're a Stockholm-based fund. We operate slightly differently to most funds in that we build local exclusive groups of angel investors in the geographies in which we invest, and we integrate them with us as a fund fully. So we share everything that we think is interesting with these angels that we've decided to partner with all the time, very integrated, with the aim that we can co-invest with them and essentially have a much wider kind of team to work with the portfolio companies that we invest in. So this is actually a picture of one of our monthly meetings. I'm in the back, two of our fund guys there, and then the rest are angel investors that are very much in our group. We're in the process now of expanding to Finland and also happily the Baltics. So this is my first time in Lithuania, and I'm very happy to be here and get to know a little bit more your ecosystem as we look to be a part of it and contribute to what Kevin mentioned is an exciting time. So what I wanted to talk about a little bit today, I mean, fundraising, I think, yesterday I missed the presentations. I arrived late last night, so I think there were a few sessions about fundraising as well. It's a very important, thing that we do. I hope that I can add a different topic and different perspectives to the conversation there. It's really great to go after the guy that tells you how to, or the guy before, Gleb, who tells you how to present, so you really notice how many so's and how many ums you put into a presentation. So there we go. Here we go. So the purpose really is to reframe how we think about the process of fundraising. I think, it's something that most founders have to do. And here we're talking, going out to VCs, going out to angels. It's something that is on everybody's radar, and I think there's a way that is commonly framed as to how to do that, which is not necessarily helpful to achieving the best outcomes in the process. So to reframe that approach, and in doing so, to empower founders to be more successful in raising money and achieving their aims in fundraising. So actually, as I was putting things together, I realized that a lot of the perspectives that I wanted to get across had kind of a red thread towards being very much comparable to the way that you build a product and run a product development process. So I had a slight title change there, and previous to founding J12 on the investor side, I was a co-founder at Novo, which is a fintech company where I was head of product. So I think it's this mixture of experiences on the investment side and on the product side that kind of brings these two together. And then I had one more change where I think I arrived at a slightly catchier title, so that's the one that we're going to run with. So before we jump in, hands up if anybody has raised money from angels or VCs before. Okay, a few. And hands up if it took longer than you thought it would take in the beginning, or if it took a slightly different shape to how you thought it would take in the beginning. Good, the same few. Then we have something to talk about. So let's just quickly recap. I mean, what is the aim of raising money? I mean, money is one thing. You have a business strategy, you have a roadmap, you want to execute on that. There's an amount of money that you think that you need to take that further. So you have an aim of bringing that money in to pursue that roadmap. You obviously want to get the full amount. You want to do that at a valuation that you think represents how far you've built the business and represents kind of the ownership that you're willing to give up at this stage of the business also. Most people probably want to, gain some contribution at this moment as well, to get investors that can contribute so-called smart money with the knowledge, network, and experience that is relevant, with matched money in terms of your strategy, your vision, your timeline for the investment horizon, what do you want to do in the near and the long term, and committed money in that they actually are willing and committed to work with you and to deliver some value. You probably want to get good terms, whether you've raised money before or not. It may be that you're a little bit, afraid of the negotiation of terms with investors that do this a lot, and you don't know exactly their aims around it. So you want to reach an agreement with people that is friendly and aligned, rather than kind of competing. You want to be in the same boat. And most people want to get this process done quickly. Certainly, you have a runway linked to your strategy that you want to be in accordance with, and most founders tend to see the fundraising process as a bit of a distraction. So the normal approach that I observe in meeting a lot of founders when people start to prepare to raise money looks a little bit like this. Bam. So it feels like a lot. You reach a certain point with your company, you recognize that you have a capital need, which you define, set a valuation or a range at which you want to raise that money, look at the kind of investors that you think you'll raise it from, the time frame in which to do it, and then you design and develop the approach with which you want to go out and do that, get some feedback, and then boom, it's fundraising time. Now we're fundraising for the next period. And this is what you expect. So you do that, you build the company, you do that preparation, we start fundraising, we expect to finish fundraising in a few months. We'll raise what we wanted to raise at the valuation that we think that we're worth from the kind of investors that we want to get the money from within this time, and then we continue. In reality, it tends to take a lot more time than you think. And along the way, you have some changes to the amount that you manage to take in, the kind of investors that you manage to attract, or that you realize are the best fit for what you want to do. And in accordance with that, you have to adapt a little bit the strategy from that point on. In the worst case, the fact that it takes longer is so detrimental to the business, depending on how much runway you had when you started, that you may really run into trouble. So a general rule that I think you may have heard a lot when it comes to a lot of things within startups is that everything kind of takes twice as long and costs twice as much as you planned in the beginning or you thought it would. And fundraising tends to be no different to this. But why is this the case, and what can we do to have slightly better outcomes? So now let's look at another process that I guess a lot of people are very familiar with. I get a lot of founders here are building products or are specifically engineers or product people. So how do we build products? How do we find product market fit? Well, one approach that has previously been popular, but a little less so, is to take kind of a waterfall approach to building a product. So you spend a lot of time defining requirements, deciding what it is that you want to build, designing it based on kind of minimal feedback, developing it, getting some testing of feedback, debugging, and then you deploy and you launch and you expect it to go well. Probably not. You're probably not going to find product market fit within 2 to 3 months if you launch a process like this and haven't included customers in the process. You haven't validated the product along the way. You're trying to sell a product that you don't know if anybody wants. It turns out that nobody does want. You don't know who your customer really is. And in the end, after launch, you have to make significant changes to the product, to the strategy as to go to market, who to sell to, how to sell to them. And it's another case of something taking twice as long and costing twice as much as you hoped it would. So an alternative approach, which I think, many companies are very good on the product side of things. They're very good at taking very iterative approaches with very short feedback loops, including customers in the product process all the time, getting constant feedback on what customers want, what their needs are, frequent releases, so that when an eventual bigger launch, bigger push towards sales and go-to-market comes, you've validated so much more. And this tends to then lead to a much better outcome once you do that bigger push and launch. So we have these two approaches in product, and most of the founders that I meet are very, very good at the iterative approach towards developing a product that their customers need and want, and then launching that in a more successful fashion, rather than taking a very kind of process-driven one step after the other and, you know, launching based on assumptions rather than validations. So if we look again at the approach to fundraising, this is what we had earlier. So we have these steps, and you can see quite clearly, really, that, you know, you're really starting by kind of saying the requirements. This is what we want this is what we've built, this is where we are, this is what we need, this is what we're going to go out with, this is what we're going to get. You design a little bit, you know, where that's going to come from in terms of investors, how long it's going to take, what's going to happen. You develop the materials, minimal impact from the market that you're actually going to go out to at this point, and then you launch with the expectation that in 2 to 3 months, you're going to achieve these aims. But as with launching a product and going to market there is much that is not validated, and there's much that you only start to learn after you launch. Okay. So yeah, a lot that is not validated. You cannot be sure that your value to the full amount that you want to raise. You don't know if the money's in the market, or if the investors that you want to attract are the investors that are willing to invest that much. You haven't validated that you really do have the metrics that reflect the stage at which you think you are to secure the valuation that you want to reach. So you may end up realizing that you have to raise a smaller amount at a lower valuation, and that takes some time to figure out if you haven't figured it out before. If you haven't had a dialogue with investors along the way, you don't really know who is the investor that is the smartest, best fit for my company, who really does have the knowledge, network, and experience that can add the most to me, who is really the best personality fit with me that I can get along with. And, you know, I think that is at least as important, especially very early, to, you know, having investors that know your space is having investors that are aligned with your vision and you can have a very transparent conversation with. You know, as Kevin mentioned in his presentation just now, I mean, there's a lot of the inside of entrepreneurship, and a lot about, you know, the challenges and the psychological turbulence of being a founder, and it's a big role of an investor to be good at managing that as well. So if you run kind of the waterfall process of fundraising, as we saw before, you get to the start of fundraising, and it's only at that point that you start to validate. So that is why it takes so much longer than expected, and you run into a lot of potential problems because you're validating very far into the process of looking to raise capital. So this is a common interaction that I have with founders when I meet them. You know, when do you aim to close this fundraising round when they're funding? And a lot of them answer, as I think you saw, still getting to grips with the clicker. A lot of founders answered that they wanted to close yesterday, and this is obviously not a great signal. It shows an element of poor planning. It largely suggests that the founder has run some kind of waterfall approach and is very tired somewhere between start and close, and really doesn't want to be there anymore and wishes that everything had closed yesterday. And they don't really know where close is, they don't really know how to get there, and they're trying to figure it out, you know, as the cash is starting to run low. So before you reach this start point and, you know, kind of announce that you're formally raising funding, there's a few things that you should really make it your business to know, in the same way that before you really push on going to market with a product, you make it your business to know about your customers. So which investors really are the smart match committed money? You know your market, know your customers. What are the criteria that they want to see with regards to team, market, product traction? I mean, this is what they're going to judge your case on. Different investors look differently at cases. So, you know, you might think that you have the traction, but then when you get out and have a conversation with investors, you realize actually, you know, they're more interested in retention than acquisition, or your number isn't as high as they think it should be. And then you have to work for a few more months to get to the point where they would like to see you. If you'd had that conversation earlier, you'd be there by now. And another thing that you would want to know is that you've achieved, yeah, exactly. So how could you know that without discussing and developing, your case with investors in the same way as you discuss and develop a product with customers? If you've not validated these things before, you can't really expect to meet those aims. It's a naive approach to fundraising. Jeez. So exactly. If you don't validate a product, I think most founders, most product owners understand that they can't expect a launch to be highly successful. If you don't validate your case before reaching a phase of fundraising and really making that a primary part of your business, you can't expect to optimize for the type of investors, the amount, the timing, the valuation. So this is not the most romantic way to look at your company. Your company is a lot of things. It's your vision, it's your mission, it's your culture, it's your passion, it's the product or service that you actually build. It's a lot of things. But at the end of the day, if you need to take in external capital from angels, from VCs, from anybody, in order to realize that vision and that mission, then you have to look at your company as a product, and investors are the customers of that product. They are in the market to buy into good companies and help them to reach where they want to get to. So I think that is an important way to view it at times. So if you start to apply product thinking in your fundraising approach, then it's important to look at building your company while building investor relations. It's not something that you can do for, build the company for 9 months, go out to investors for 3 months. You don't build a product for 9 months, sell it for 3 months, go back. It has to be an ongoing thing. So take more of an iterative, constant feedback approach in terms of speaking to investors, gathering feedback on where you are, where they would like to see you. It's not that you need to follow the path that they set out, but it's important that you allow them to understand the path that you're trying to take. And two of the key benefits that you probably realize from taking more of an iterative and agile approach in your relations with investors along the journey is that you will know your aims better in terms of what you really want to achieve with the round. What should your roadmap be? How much money do you need? How can you attract the smartest, most committed money? And in running such a process, you will also present a much stronger case to investors because they'll have been part of the conversation with a lot more touch points along the way. So it's incredibly simple, really, how an agile approach to fundraising looks. It's really about maximizing touch points and gathering feedback in the same way as you would do with customers while developing a product. So speaking to investors frequently, understanding their aims and needs. Investors have some constraints and investment scopes in terms of geography, industry, stage. These might be things that you feel that you can research very well, kind of in a desktop fashion, reading online, but unless you have a real conversation, how much do they allocate to early stage or seed? How does their portfolio look with regards to the split between different industries? So there's a lot more to understand there. There's also a lot more to understand in terms of, how does this investor judge team or judge product? Some investors will, look for an incredibly high amount of product risk. We heard the speaker earlier not interested too much about market opportunity. Looking at the team, how does an investor judge a team? What do they want to see in a team? How can you expect to portray what a great team you are if you only give the investor kind of a 1, 2, 3 month window to really get to know who you are and how you work? So share your progress often, ask for feedback, In doing so, co-create the process with investors. There's a lot you can do to ask for a favor. It's well known, I think, that people like you more if you ask for a favor. There's a lot you can do to make investors already invested before you actually ask for money and investment. If they're already helping, if they're already making intros, if they're already advising in some capacity, then the emotional side will speak to that. Whether it's them that invests or somebody else, they're already looking to help you. Build real relationships. At the end of the day, especially in the early stage, investment fundraising is not so much a financial question. There's not a huge amount of metrics. There's not a lot of numbers to go on. There's an emotional side, an irrational side, especially with angels. There's a lot of people matching. As mentioned earlier, you really want to be selective in who you bring into a company that you're looking to build for the next 10 years. So be selective and get to know investors by building real relationships with you. If an investor is unwilling to help you before they're invested, it's not necessarily a good signal that they're the kind of investor that you want to bring on board. And constantly test the case you think you're building. Many founders, communicate where they're going to be when they start fundraising, what it is that they are going to base that fundraising on, essentially the case that they think justifies what they want to do. But you have to stress test that all the time with your potential customers, with investors. And if you do that, then before you actually need money, before you go out and really look to secure it, you'll have built a lot of trust, strong relationships, provided a lot of evidence with regards to the things that investors want to look for in terms of team, product, market, rather than only presenting it, when there's a decision to make, when you're asking a question about investment or not. You'll have established the metrics that want to be seen rather than just making assumptions about, which metrics are most important. And if you've done a good job of co-creation, then you'll already have some investors at least partway sitting on your side of the table rather than approaching them, on opposite sides. And so lastly, one of the two key benefits mentioned earlier, one was that you can understand your aims a lot better. The other is that you can, do a much better job in presenting your case to investors. If you take this iterative approach, constant feedback and communication with investors prior to really fundraising, you'll be able to provide them with lines and not dots, which is incredibly important, and investors will love you for it. So if this is the last time you spoke to an investor, or maybe it's when you started your company, it's the last data point that they have. If you run more of the waterfall process that we saw in the beginning, and now you go out to investors and you present, this is where we are now, we're raising money, this is where we want to be in 12 months, you're heavily betting that the metrics that you have here are the perfect metrics, and that this is the case that is going to convince investors to invest now. If you run more of an iterative process, you can give them that line. You can show them how you got there. It may be that dot isn't the right dot that you're at, but at least they know how, why, and what you did to get there. You have a track record of execution, of how you take decisions, how you build product, how you market, how you hire, how you get from one place to the other. And it builds a much stronger case and evidence that actually you might be able to get to the next dot in 12 months. We can start to see a trend, and we can believe that actually you are the team that can execute on what it is that you want to do. So I think that is a takeaway. I think many founders are very good at building product. They run those processes very well. I think it doesn't always come naturally to raise money, and it's often seen as a distraction from the core business. I think that need not be the case. The two can be integrated. So always stress test your fundraising strategy in the way that you interact with investors in the building of your company with your product thinking and what you're doing in terms of developing product and speaking to customers. If you see that you're much better on the product side than the investor side, then there's a lot that you can do to improve there. So the key takeaways: think of fundraising as a product development process. Your company is a product, and investors are your customers. Take that framing and see if that changes a little bit the way that you approach that. Take more of an agile and iterative approach towards investor relations rather than saving it for a certain time when you've reached a stage where you think that you're more relevant. You can always have conversations with investors. It's the nature of the conversation or the content of the conversation that might change, whether you're actually taking in money now or if you're pre-product, or if it's a vision, if wherever you are, if there's some kind of fit between you and the investor, there's always a conversation you can have, there's always learnings that you could take. So aim to spend a few hours per week or something similar rather than a few months per year. Maybe it will seem like a distraction as you change that process and start to do that, but I assure you it's a much more efficient way, and those that are more successful in raising money and the kind of money that they want to raise take that approach and are very good at nurturing these relations on an ongoing basis. And related, as a result of everything else, or ignore everything else and just focus on number 5, I think it's very important, but it comes as a consequence. Try to present to investors lines and not dots. Many founders go out with a pitch deck that gives us a snapshot of where they are with maybe 1 or 2 slides of what's going to happen forward and what's happened backwards, but it's still a moment in time and it's one data point. And I'm sure there's a lot of data fans who would appreciate that the more touch points, the more data that you give an investor on, the more they're going to thank you for it, the easier it is for you to sell your case into them. So look at giving lines and not dots. And that's my express run through taking a different approach to fundraising as to what I've experienced many people tend to do. Thanks.